that will pay you, say, $20,000 a year in income, but have costs of holding the asset are 30 grand. In this example, the investment is negatively geared by $10,000. The net property loss results in tax benefits to the investor, as they are generally able to claim the deduction against their other income such as salary, business income, or whatever else they've got going on in their tax return. The capital appreciation of the investment is a critical factor in this investment strategy, but I'll touch on this later in the presentation. So that's the theory of negative gearing, and so how does it work? I find that a practical example is probably the easiest way to explain how negative gearing works, so I've prepared one to go through for tonight. So here we have a fictitious client, Ashley. He earns $100,000 in his job and has been looking around the local property market and has found an ideal investment property that ticks all the boxes for $400,000. He owns his own home worth $550,000 and has a loan of $200,000 on it. Ashley is a fairly typical client that is looking at rental properties given he's earning good money and has built up some equity in his own home. After speaking to Brendan at More Mortgage Options, he's been able to organise an interest-only loan at 6%. The way the loan is to be structured is he borrows 80% against the new property and the remaining 20% is borrowed using a redraw available against the mortgage on his current home. Effectively, this means that Ashley has two loans to buy this property. One large loan secured against the rental and one smaller one secured against the family home. Just on this subject, I can't stress enough the importance of getting the loan structure correct, especially the 20% redraw on the home loan. Ideally, this should be done as a sub-account on the home loan, which is split into a private portion and a deductible portion being for the investment property. The reason this is so critical come tax time is it is easy to work out what interest is claimable and makes the accountant's life simple. So getting back to the example, we've got rental income of $20,800, agents' commissions at 8% of $1,664, loan interest of $24,000, rates and land tax, body corporate, water and insurance. Given this is a fairly simple example, I've ignored stamp duty and legal expenses as well as depreciation. Depreciation is quite a complex issue and I'll cover this off in a future webinar. So after all this, the income and expenses have given Ashley a rental loss of $9,364. When Ashley lodges his tax return, he's able to claim this $9,364 as a rental loss against his salary income. So what does this do to his tax position? Once again, the easiest way to explain this is with an example. As you can see in the left-hand column, there is Ashley's tax position without a property. He has $100,000 worth of salary income, no deductions, so his taxable income is $100,000. Ashley pays $26,000 tax on this $100,000, which means he's left with $73,300. On the right-hand side, we have factored in the rental loss that Ashley has from his new property. Same salary income of $100,000, but the rental loss of $9,364 has reduced his income to a bit over 90 grand. Ashley needs to pay $23,048 tax on this income, leaving him with an after-tax income of $67,588. We know the rental losses cost Ashley a little over $9,000, but the difference between his after-tax incomes in the two different scenarios was $5,712, meaning the taxman has helped subsidise Ashley's property investment. $5,712 equates to roughly $110 a week. This cost per week term is a term that property salespeople will use. So when you hear this term in the future, you know what they're talking about. So even after the taxman has chipped in his share, this is still costing Ashley almost $6,000 a year to keep the investment running. So you might be thinking to yourself, why would you do that? The answer to that is capital appreciation. Ignoring the capital gains tax issues, but as long as the property is growing in value by $5,712 a year, Ashley's breaking even. Anything more than 1.5% growth and he's in front. There are times when the property market does track sidewards and even falls in value, but the investors who have done well using this approach have taken a 5 to 10 year time frame to enable them to go through a full market cycle and ride out any short-term volatility, which can obviously happen in the market. The key thing with property investment is capital appreciation. So it's critical you're buying the right place in the right location for the right price. If you pay $450,000 for a place that's only worth $350,000, you've got a lot of catching up to do before you get into positive territory. A question I get asked quite a lot is how do we get these tax benefits from the ATO? With the timing of the tax benefits, there's two ways an investor can get their tax refund each year. The first is at the end of the year when they lodge their tax return. They claim their rental loss and get a nice big tax refund check. It's a nice problem to have. The alternative is to do a PAYG variation. This is a form that's lodged generally at the start of the financial year where you estimate what your tax position is going to be, what deductions you'll have, the rental loss and whatever else is going to be included in your tax return. Effectively, it's an estimate of your tax return. By lodging this form, the ATO will estimate what your likely tax refund will be, and they tell your employer to withhold less tax each fortnight from your pay. This has the impact of increasing your net pay into your bank account. So instead of getting it all in a lump sum at the end of the year, it's spread over the financial year. Just on that though, as a word of warning, I've seen a few clients get stung by this. If you go down the PAYG variation path, it's to err on the side of caution when estimating your expenses. A few years ago when interest rates dropped dramatically, a few clients lodged PAYG variations assuming they'd have a much higher interest expense. But when it came time to doing the tax return, the interest was a lot less, meaning the rental loss was less, and the clients had a tax bill. If you're too far out with your estimates and you do have to pay tax back to the ATO can stop you from doing a PAYG variation again the following year. So it's important to get those estimates as near as possible. For all the listeners thinking about which one should you do, the PAYG variation or getting the lump sum at the end of the year, it really does depend on personal circumstances. I know the financial maths of it says you should get the money from the taxman on a regular basis, but my view on it is if you can afford to carry the property and get the tax refund at the end of the year, do it that way. The reason for that is if you're getting a tax benefit of $80 a week, chances are it will get spent. It goes into the bank and goes into consolidated revenue. The other option is to get a check for $4,000 at the end of the year. If you're disciplined enough to save $80 a week and put it against the mortgage, the variation will work, but the tax return at the end of the year, I guess it's a forced savings, which, it's a way of saving $4,000, which is something you can do with at the end of the year. In any case, it should be whatever works for the individual.
Thanks very much, Paul. That's a wonderful summary. Thanks very much, Paul. That's a wonderful summary of things that people really need to consider. One thing you did touch on was you talked about stamp duty and legal fees. Would you like to elaborate a little bit on how that ranges from state to state?
Yep, good question, Luke. Some of the listeners out there might be aware that in the ACT we've got leasehold land, which means we don't actually own it. We lease it for 99 years. The tax law that says stamp duty and legal fees incurred in relation to a lease are deductible. Usually this means a more traditional lease arrangement, but the theory stays true for leasehold land. What this means is in Canberra it's possible to claim the stamp duty paid in the first year as a rental deduction, which gives a bigger rental loss and thus a bigger tax benefit in year one. For all the other states and territories, they've got freehold land, so stamp duty and legal fees incurred in purchasing these properties are added to their cost base when they sell it. It means you do get to claim them just at capital gains tax time.
All right, that's great, Paul. Thanks so much for that, because it's always something that people talk about and everybody's got an idea on how things can be structured for them and their situation. That brings us to our second speaker for the night, Brendan O'Reilly from More Mortgage Options. Brendan's got over 7 years' experience in the mortgage industry and comes from a family of mortgage brokers, with his father, mother, brother and sister all working in the same practice. Brendan specialises in residential lending. That doesn't matter whether it's your first home, your 10th home or your 15th property. Brendan can normally structure something that makes sure that it's right for you. Brendan's going to be talking tonight on fixed and variable loans and the things you need to consider. So with that, I'll pass it to you, Brendan.
Thanks very much, Luke, for that kind introduction. As Luke mentioned, tonight I'm going to be looking at fixed versus variable loans and provide a bit of an insight into each rate type. Okay, so first of all, with variable rate loans, they are based on the RBA cash rate and they can fluctuate at any time during the loan term. Now, this can be based this can happen due to an RBA rate change, or it can be changed by the lender. Now, we'll examine this second point shortly. In regards to fixed rates, the rates are locked in at a certain rate for a certain period of time. This can be for 1 year all the way up to 10. The applicable rate is fixed in at settlement of the property, but most lenders do offer the option of paying a fee to lock it in at time of application. Now, this is called a fixed rate lock-in fee and is generally worked out as a percentage of the loan amount. Just on this, something to be wary about: if you pay a lock-in fee with certain lenders, you'll actually get the rate you locked in at, even if the fixed rates drop before settlement. Certainly worth you asking the question before you commit to locking in a fee. Also, the lock-in period is generally 90 days, so if you don't settle within that time period, you'll get the applicable rate at the day of settlement and they won't refund you the lock-in fee. Okay, so just moving on, we're just going to look at the features and benefits. Now, I've drawn up this table just to demonstrate the flexibility of the variable rate loans. Now, I won't go through all of them in too much depth because there's a fair bit to get through, but I'll just highlight a couple of points. Now, first of all, you can't have a 100% offset account with fixed rate loans. Now, there are some exceptions, but as a rule, it's not possible. Some lenders do offer a partial offset, which means that only a portion of the bank balance in the bank account is taken into account when calculating the interest savings. Extra repayments with fixed loans, not really important with investment loans because generally they're going to be interest only anyway, but for owner-occupier loans, you can generally only pay a certain amount over the minimum over the course of a year, and this is normally about $10,000. Redraw facilities, so with fixed rates, you can't get access to the extra funds you paid into the loan. Again, there are some exceptions, but as a rule, not possible. Refinancing, now this is a really important one because it also applies if you need to sell the property. Now, with fixed rate loans, if you break the loan during the fixed period and you fix at a higher rate than what's currently on offer, the banks will charge you what they call an economic break cost. Now, this is based on how much money the banks will stand to lose if you break that loan, and it all depends on how long you've fixed for and current rates. Okay, now, next couple of slides, we're just going to look at the variable rates over the past 8 years, and as you can see there, the variable rates, the basic variable and the standard variable do mirror the RBA cash rate. Now, we can't go back any further than the 8 years because previous to this, the RBA didn't provide or didn't track the discounted variable rate, and the discounted variable rate is more realistic when we're comparing it because most people are paying less than the standard variable rate. Well, I hope so anyway. If you aren't, you have to give me a call ASAP. Okay, so now this data, what it does, it averages the basic variable rate across the 4 major lenders. Now, we're going to look at the margin, which is the difference between the RBA cash rate and the basic variable. Now, between June 2004 and June 2007, you'll see there that it was fairly consistent, fairly stable, fluctuating a little bit, but not too much. Now, it all changed in 2008. Things started increasing. So you can see there 1.6%, the margin at June 2008. So this is around the GFC. June 2009, 2.15. June 2010, 2.25. June 2011, 2.3. And February 2012, we're looking at 2.6. Now we can't go any more recent than this because the data is unfortunately not available, but you can see there that obviously since June 2007, the margin has almost doubled. Now, the banks, we can say the banks are greedy and we like blaming them, but there's another reason why this is the case. And this is the X factor, and it's the cost of funding. Now, the big four source approximately 30 to 50% of the funds they lend to customers from the wholesale lending market. So that can be local and international. The other 50 to 70 comes from term deposits and bank accounts. Since GFC, global investors are demanding higher returns for their investments due to fear of what happened in the US. Now, also growing instability in the Eurozone recently has also added to this. So the bottom line, NAB released a press release and they used to pay prior to 2008 0.04% above the RBA for their borrowed lending on the wholesale markets. Today they pay 1.48%. Okay, so moving on to the fixed rates. Why would you fix? Now, I call it SANF, so it's sleep at night factor. You know exactly what your payments are going to be for the term of the fixed rate period. It's set and forget, no need to worry about the loan except for the repayments until it expires. Potentially diversification, so if you've got a few properties with a fair bit of borrowings, it would be a good idea to have at least some of it fixed, just so you've got a bit of protection against interest rates rising. And also, another point, you can also fix for different periods. So if you've got a few loans, you could fix one for 1 year, maybe one for 3 years, and you could actually spread your risk and increase your protection. Okay, so now we're going to look at over the last 8 years again, but we're also going to insert the 3-year fixed rate and compare it to the variable. So again, this is across the 4 majors. So yeah, you could have potentially got better rates or worse rates depending on the exact lender at the time, but this is just the average according to from the RBA. As you can see, over the last 8 years, they've been generally around the same mark. Now I wanted just to have a look at a few periods in this time and actually work out which would have been better off. Now, if we look at, if you fixed at September 04 for 3 years, you would have been $1,200 better off if you fixed. This is a nice one, September 05. I wonder if any of our listeners are in this position. September 05, you would have done really, really well. You would have saved $9,500. Moving on. So this is November 06. Variable wins, but it's a marginal win. As you can see, the rates went up, the rates went down, but overall, you have just won by having a variable rate. Okay, so this is an interesting one. I hope this one here, variable. So shortly after, variable wins by 8,300. Now, if you fixed here, you'd be kicking yourself. So this is June 08. If you fixed at June 08 for 3 years, it would have cost you $25,000. Now, if you realise that the rates had come down, you saw a bit of value at this point in time, and you fixed, and that was in March 2009, that would have been a good win, about over $7,000. You would have been better off. So, conclusion. It's 50-50. Major things, don't fix if there's a chance of you selling the property during the time you fix for or you need to refinance. Consider getting the best of both worlds. Consider a 50-50 split between fixed and variable. So you get the flexibility of the variable side of it, so with the products, but you get security against rates rising. Don't fix for over 5 years an absolute maximum, because any more than this, the lenders build in too much volatility into the rates. Now, look at the past and consider the future direction of interest rates. Are they likely to stay low or are they on the rise? Don't fix a loan that is secured by property that you may sell, and avoid cross-collateralization. Now, I'll be exploring that second point in a future webinar, because that's a whole entire different story. Now, to finish off, it wouldn't be a presentation about interest rates if I wasn't going to at least look at the future direction. Okay, so this is the ASX rate tracker. Now you can download this off the ASX website. We look at it quite often as it provides a bit of insight as to what the futures markets expect in regards to the RBA cash rate. I certainly wouldn't use it as gospel, but it's very good, strong indications at the moment that further rate drops from the RBA are likely. Now, they're factoring in quite a significant amount between now and February next year, as you can see. They're talking about rates coming down at least another 1%. Thank you very much.
Thanks very much, Brendan. Thanks very much, Brendan. From a planning perspective, we have a number of clients that come in with various gearing loans and properties, and when we discuss with them how they're going to protect their cash flow, they say, it's okay, we've got mortgage insurance. So I was just wondering if you could quickly touch on what mortgage insurance does, who it actually protects, and how it's calculated, because as I know and we display with clients on a regular basis, it is not protecting the investor.
Yeah, thanks Luke. As you say, it is a common misconception with mortgage insurance that it does cover the borrower. Certainly not the case. It covers the lender, and in case of a borrower defaults, the mortgage defaults on the mortgage, the lender will not lose out. Now, there's an insurance premium for this, and it's not paid by the bank, it's paid by the borrower. Now, this is applicable when the loan-to-value ratio is above 80%, and it's also based on bands as well. So, if the loan amount is between 0 to 300,000, loan amount between 3 to 600,000, 6 to 9, and so on. It's also based on the loan-to-value ratio. So, the higher the LVR, the higher the risk, the more the mortgage insurance premium is going to be. To give you a rough idea, on a 400k purchase, you're probably looking at about $6,000. Now, that's the negatives of it, but it does allow people to get into property when they don't have a 20% deposit, or for investors looking to leverage harder on their investment property portfolio. Another thing as well, LMI applications are generally harder to go through because they're not just assessed by the actual lender, they're also assessed by the mortgage insurer.
That's wonderful, Brendan. Thanks so much for that. So the ongoing conundrum of fix or to not fix, that will always seem to be the question plagued by investment property opportunities, because we're always seeing the RBA, especially of late, moving that cash rate up and down to keep the economy moving. On that note, Brendan's presentation will conclude our first webinar. As I mentioned earlier, if you do have any questions or about anything that's been addressed tonight, please feel free to contact Paul, Brendan or myself on the numbers provided on the screen. As part of an Understanding Series membership and taking your time to log in tonight, Brendan has offered all listeners a free health check to confirm that they have the sharpest and most appropriate rate available for either existing loans or for upcoming loan opportunities. Similarly, if you have any questions in relation to what Paul has talked about tonight, he's agreed to answer any questions at a reduced rate, and he can be contacted for more information. So what are some of the key takeouts of tonight's presentation? 1, make sure you structure your loan correctly. 2, work with your accountant to manage your cash flow and your tax to incorporate lifestyle, because we all have ongoing living expenses that we don't want to have impacted. 3, if you're going to estimate your cash flow, be conservative, because it can come back to haunt you at tax time. And 4, ensure that you've looked at your rates, because things do change over time and it's important to stay on top of it. In our next session, we'll be talking about protecting cash flow, because that is your most important investment guideline when funding gearing loans and accumulating wealth. And Paul will be expanding on what he's talked about tonight, and will be addressing depreciation and capital gains associated with property investment as we move into tax time. We'll be sending out invites for the upcoming webinar when the date has been finalised, and everyone will be notified of when that will occur. That brings tonight's sessions to a close, and on behalf of Paul, Brendan and myself, I'd like to thank you again for taking the time to logging in, and we look forward to answering any questions and speaking with you at our next session. Good night, everybody.